Thank you for the introduction, and thank you guys for sitting completely out of order, so I have to make it even more difficult. As she mentioned, we're here to talk about on-chain yield, but first I'll let my panelists introduce themselves. Arthur, do you want to jump in first?
Hello, good afternoon. It's great to be here. My name is Arthur, looking after sales and business development for Flowdesk in Asia Pacific. We are a global automated trading group and deploy liquidity on and off chain, so right on topic here, as well as provide trading services and solutions to help on one side projects, but anyone involved with digital assets trading, enabling the markets with a service view.
All right, hey everyone. My name is David Zhang, not to be confused with the other David. I have two different stablecoin projects. So one of them is dTRINITY. So dTRINITY offers subsidized stablecoin borrowing in DeFi. And I also am the co-founder of Stably. We offer stablecoin as a service for institutions who want to launch their own stablecoins.
Hey everyone, my name is David Tai. I'm the co-founder and general partner at Kronos Ventures. We're an early stage VC fund targeting pre-seed and seed round deals in the crypto space. We've been investing since 2021 and happy to be here talking to people.
Hi everyone, my name is Yanshan. I'm the head of APAC at Figment. So at Figment, we pride ourselves as the world's largest institutional proof-of-stake blockchain infrastructure provider. Right, we manage more than $15 billion worth of assets under stake, and we mainly target institutional clients and with our safe and reliable staking ecosystem. Right, so we look forward to work with all the institutional players here in Vietnam and to see what kind of value we can add in terms of on-chain yield and staking infrastructure. Thank you very much.
Great, so let's dive into the first question. So let's start with like an overview of the current market state. So last cycle, on-chain yield was driven by liquidity mining, inflated incentives, and a number of other areas. But now we've seen a slight transition this cycle, and especially in the last year. So I wanted to start, maybe Yanshan, maybe you can start talking about what the current market state of on-chain yield is and how it's changed since the last cycle.
Yeah, I think when we look at on-chain yield, right, a lot of these projects are kind of facing, I'll talk about the problems that I'm seeing right now, right, because that's really what is the crux of all the on-chain yield solutions and what they're trying to resolve. So essentially, the key problem here is the cold start problem, right? Where you see out there's a lot of battle-tested, proven strategies already that allocators are already invested in. So what would make them really want to shift over to something, a new project, for example, that is more, that's new, that's innovative, even if they have strong capital backing, right? So it's really on the incentive side, right? To be able to start these projects from nothing to something. Now, incentives is what I'm seeing, right? A lot of players are giving out incentives, but incentive design is even more important, right? So how can these incentive programs be encouraging stickiness, right? How can they be sustainable over the long term? Right, so some good examples that I'm seeing out there are, for example, like Hyperliquid's buyback mechanism, right? So that's what I'm seeing that is much more prominent in the on-chain yield ecosystem, where they're actually generating revenue, right? So real revenue going into the assistance fund and providing that sustainable incentives. And what is driving that real revenue? Real use case, right? Where in short, Hyperliquid provides real, safe, reliable, fast, decentralized exchange ecosystem where the fees go to the users instead of the middleman. That's the value it adds, right? So at the end of the day, what I'm seeing on the on-chain yield market and what is successful ties back to this crux of real-world value add. Yeah. So hand over the time.
Yeah, David, if you want to jump in.
So I feel like this cycle has gone on for so long that a lot of us have forgotten about, one of the big sources of yield this cycle, which is like staking and restaking, right? I mean, I think that's kind of what kicked off a lot of the yield farming mentality from DeFi users in the past like 12 to 18 months, right? So you had, Ethereum staking, and then you had like, these other protocols launch their own LSTs, and then you had restaking. So for me, that was the biggest shift, right? We went from, Ponzi-nomics to slightly more sustainable Ponzi-nomics, I guess. But like essentially this opened up all sorts of new types of businesses, right? Now you have protocols who are dedicated to making, liquid staking or restaking products more efficient. You have, like yield loopers, which are basically doing like basis trades across these different yield-bearing assets. And, but this is just for native assets, right? Like ETH, Sol, Sui, whatever. But stable coins have kind of seen a similar surgence, I would say about 12 months later. So I think Athena really, kicked the trend and put it on the map. Now you have people who have started to realize, hey, why am I holding these non-yield bearing stable coins, losing money to inflation, which has been very noticeable for the past few years, right? As well as the opportunity cost of, just not doing anything with your money, when I could instead, hold SUSDE, or I can, provide capital for some, new yield-bearing stable coin pool or something like that. So I think USD denominated yield, driven by these yield-bearing stable coins, and native yield driven by staking and restaking, like that to me has been the biggest noticeable trends of this cycle.
I think it's super interesting. I just want to add a couple of shifts, right? So when the DeFi space started, maybe 4 or 5 years ago, right, the only forms of yield was I can take, USDT, put it on Aave and earn crypto native yield. What is crypto native yield? Is basically you have borrowers on the other side that are willing to pay a cost to borrow because, they don't really need the capital. They can take the borrowed capital and go trade on it. Now, it worked out well in crypto bull markets because the cost to borrow was very high and people are willing to pay those borrowing costs. I think Aave yields at one point in time, I think in late 2020, early 2021, were in excess of 10%, right? But what happened, when you hit a crypto bear market is the yields go down to extremely low. No one really wants to borrow. If no one really wants to borrow, right, your yields are de minimis. So what happened then? Well, there's a rising trend there where if you look at what's happening with interest rates, right? Interest rates are rising, which means that if I go and I invest in the real world, a risk-free rate, treasuries, right? I'm earning 4.5%, 5%, and people are saying, okay, so why can I not, transfer some of that onto the crypto space, right? So the rise of RWA yields, and I'm just talking about treasuries at the moment, but there's other forms of RWA yields, right? Brings almost kind of like a hedge against what will happen in a bear market for yields, right? People will just offload from crypto native yields into RWA based yields, and many protocols are doing something like this, right? To what Yanshan is saying about incentivization, I think that should exist to bootstrap users, but me coming from like a traditional finance background, I always think that in the end state of a protocol, right, it cannot just be inflationary Ponzi-nomics, right, that'll sustain the value of your yielding protocol. So that's kind of like my 2 cents.
Yeah, all very good stuff. I would say that as well. What we tend to forget is looping back the stablecoin and yield-bearing stablecoin brought what we'd say a DeFi revival, because all the way we were all looking back about that DeFi summer, and then all we've seen is pound schemes, really looking to farm balance sheets of institutional players, but in the end there is no sustainability, exactly. Whereas here, yield-bearing stablecoins help to unlock capital, where, for example, they can be used as collateral. So in a totally sustainable way, on one side, I had what was first tokenized money market funds. They were not really doing anything on their own. People were like, oh yeah, okay, that's great, it's new, it's on-chain. But it didn't really solve anything more than what was off-chain. However, the moment you make a stablecoin that is backed by those money market funds, then that instrument can be used as collateral, either in other protocols or even to enable trading. Okay? And suddenly that becomes then sustainable over time, regardless of any additional incentive that's being chased. Yeah. And look at this. Now we see that 2 years, like 2 years ago, the overall yield-bearing assets market was about 600 million in TVL. It is now close to 9 billion. Billion, just to be clear, not million. So we see that growth is here, and it's because it's solving real problems in the industry. Now it's still concentrated. The next step, it's how do we scale this even further? Because out of that close to 9 billion, 6 billion is USDE, which did a phenomenal job. But then you have new players, and for example, those money market funds backed stablecoin, USDO, USYC backed by Circle. Everyone is looking at ways to just enable capital for people to redeploy.
Just to piggyback and ask another question on that, the fact that most of the today's stablecoin yield is generated by US Treasury bills, and the performance is potentially about to change if interest rate change. What impact will that have on yield, and what impact will that have on the appetite of institutions and investors more generally?
I just want to interrupt. I think the framework of the question is a little bit incorrect and the reason is because of this, right? Because if you hold USDC, USDT, the ultimate user doesn't get the interest rate. It's the company, so for example, Tether or Circle, that gets the benefit of the interest rate. So in a declining interest rate environment, it just means that those companies, Circle and Tether, wouldn't earn as much, right? So, like to me, the end user, as what David said, right? If you hold USDT or USDC, you don't really earn yield unless you go and you place it into a farming vertical. Right, but on that end, it just means that instead of making, I think Tether made like what $19 billion in their first quarter. They're just going to make less, right? And I want to see competition because right now Tether and Circle are sitting in dominant position. They don't really need to spend the money to do any of these things. Sorry for the interjection, but I just wanted to add that framework.
No, that completely makes sense.
Well, yeah, and then they will have other revenue channels, right? Because at the end of the day, one thing an issuer controls, so first it will lead to more competition, I totally agree with that. And then at the end, you still have the mint and redeem mechanisms, and that's going to be your source of revenue. So it will push to be probably reasonable on the spread you take there to build a sustainable economic model, and yet introduce much more competition. And even for those main issuers, again, like Circle, for example, came up with USYC and then now redistribute the yield to its user base.
And I'll just jump on to restaking quickly, and yourself, Yanshan. So it's taken off very quickly over the last couple of years, going from an experiment to billions in TVL. But from your perspective and Figment's perspective, how are institutions approaching restaking today, and how is this changing? How do you see this changing moving forwards?
What I'm seeing right now is that institutions are cautiously approaching it, right? If you look at the value that it actually provides is that, okay, you are now staking your asset, be it Ethereum, Solana, is locked, right? It's locked in your vault or your custody. What else can you do? It's staying there, right? It's securing a protocol. Are you fully utilizing that capital? So I think this is what restaking hopes to achieve, right? Which is to allow that kind of, I would say, even dormant capital sitting there to be able to have greater productivity and secure more use cases in the blockchain ecosystem, right? So that is the fundamental principle behind restaking, and that's what's the real use case, as I tie back to that. But there's still some, I would say, issues that needs to be looked at or at least evaluated, right? So what are these issues? So, for example, like the complexity risk, right? Because when you are securing more and more protocols and applications, you're exposing yourselves to more slashing risks, right? So your base layer has slashing risk, and then now you have additional slashing risk. right? But this can be mitigated if your operator is, okay, I'm talking about eigenlayer, symbiotic, your operator is well versed in running the infrastructure on the back end, being able to manage simultaneous different sets of rules and restrictions on a very systematic manner, right? And then, of course, you have smart contract risk, right? This is the major one. Many institutions, when I ask them to do restaking, that always comes back. So it's about the auditability, it's about whether it has been verified, whether it has been battle tested. So all these things are important for institution, banks, and all they're looking to get in, and treasuries as well, right? And of course, there are a few other factors, like the yield right now is, I'm sure you guys are seeing the eigenlayer yield, symbiotic yield, is not the most attractive, I would say, but as more use cases begin to build, if builders get more innovative, tie back to real world use case, I go back to there again, perhaps we can see some improvement going into the end of 2025 or 2026. Yeah.
And David, I'll bring you in here on the yield-bearing stablecoins again. Obviously, dTRINITY is building yield-bearing stablecoins products. So who are you targeting these products for? Who's the user base currently, and who do you feel like the user base might be in the next 5 years?
So I think so far, like the user base for yield-bearing stablecoins is still very niche. Like, yes, the market has gotten much bigger than it has before, but it's still mostly people who already had money in crypto, right? And now instead of holding USDC, they hold something that pays them some yield so that they're losing less to inflation or opportunity cost or whatever, right? I think for like there to be true adoption outside of just the crypto community for yield-bearing stablecoins, I actually think there needs to be a vehicle for non-crypto people to gain exposure to this sort of yield. So like I don't think we're ready for this yet, but like an ETF that gives you access to like a basket of the top yield-bearing stablecoin yields, for example, I think could be a very interesting product. But it's still too early. Like I feel like yield-bearing stablecoins are like one cycle away from the level of adoption that institutions would need in order for them to be comfortable coming in, right? And that means there's actually a lot of opportunity space between now and then for builders to, solve problems and acquire market share, right? So the trend that we noticed and why we started dTRINITY in the first place was because we noticed that people were only solving the problem of holding stable coins. So, instead of holding USDC, I can hold a yield-bearing stable coin. That's fine, right? But what if I'm borrowing USDC on Aave, right? Or what if I'm depositing USDC on Polymarket, for example, right? There are many use cases where you need the asset to stay pegged one-to-one, but you still want to receive the benefits that the issuer is keeping for themselves, right? So the main innovation that we created is, what if we incentivized users not to just hold the stablecoin, but to actually use it productively in DeFi, right? So this is just one example of where I think some of the innovations are going to continue coming from. And by the time that institutions are finally ready to hold like very basic yield-bearing stablecoins, I think the DeFi landscape will look nothing like it is today, right? So I think there will always be, this early cohort of early adopters, right, who are willing to experiment, and in return, maybe they get higher yields, maybe they have some cost savings or whatever, more leverage, there's a lot of degens in the space, right? But I think in order for the late adopters, which are usually the institutions with a lot of money to come in, like they need the space to be proven out, probed in different areas, battle tested and whatever, right? It's just like restaking, right? Like it needs to have survived for long enough, have shown resilience, and have shown sustainability. And I think that's really what the industry is going through right now, which is why I think it'll be another cycle before we see adoption beyond the crypto natives.
And David, I can bring you in here. We're talking there about adoption just being a matter of time, I guess, like proving it's not failed for this period of time, institutions might come in. Do you feel like there's anything specific, UX or or just general regulatory changes, anything like that that can accelerate this process or that can be done to accelerate this sort of wait and see process?
So a couple of things, right? There was actually a stablecoin legislation passed last year, which gives framework around what can be incorporated in stablecoins. And one of the things that they basically said was, if a stablecoin actually bears interest, it's counted as a security, right? Which means but then that gives rise to people, like, okay, well, what do you do with the interest that accumulates, right? Well, for Circle and Tether, they don't really need to give that much away to their partners or anyone, and then they can figure it out for other business purposes. But for newer stablecoin projects, right, some of them are basically saying, okay, how do we incentivize the partners to develop our ecosystem, right? Because we can't really give it away, right? And that'll just give more market share for these tokens and all of this, right? It still remains to be seen whether the incumbents meaning USDC or USDT, would maintain the level of market share that they have. I think that on the market capitalization basis, right, I do think that there may be challenges. Already USDC is getting a significant amount of market cap share, but from the trading perspective, I think USDT is in a dominant position. I think more than 90% of trading pairs are all USDT dominated. Now, what do I see for the future? I think it's an adoption game. I think the stable coin with the vast amounts of resources that can incentivize the most amount of partners, which ultimately means, how much is their collateral and how much are they making and how much are they further incentivizing all of those partners, right? I recently, spoke with, the head of strategy at World Liberty Financial regarding kind of USD1, the stable coin there, and just to kind of get, what they're thinking about. And not only are they kind of, attacking the market cap regime, they're also attacking kind of Tether's dominance on trading pairs, right? They want to be listed on exchanges as trading pair counterparties. So it'll be like, USD1, BTC trading pairs. So the TLDR it still remains to be seen. Marketing and adoption is highly relevant because that'll just increase market share, which increases the earnings potential, which means they have more resources to inject into their ecosystem, right? That's how I think about it.
Arthur, I don't know if you had any thoughts on this one from an institutional perspective.
Yeah, to take it a bit broader as well, because we always think about institutional adoption, thinking actually financial institutions. And I think for stable coins, we forget something, it's just digital FX. And then the moment the corporate world really gets involved in terms of the volume of trades and really challenging what is the FX landscape as it stands today. And I think for that, we're actually very close. Go talk to a CFO that has to manage multiple currencies and reserves across various continents and the associated hedging risk that they have, the cost of managing all of this compared to basically sitting on reserves that generates yield, and without changing the risk profile drastically, as soon as, again, you don't go into those looping that we talked about, it's very much something that any CFO will comprehend. And I think right now that BD effort is just starting, and it's already showing, I think now we are 4x the volume just traded on stablecoins to stablecoins from 24 to 25. And that's gonna accelerate. And part of it for me is this corporate adoption, so just real money pouring in. So while it's institutions, it's a given, they are in, and then the next step is the broader corporate adoption.
And broader corporate adoption looks like what in the next couple of years?
Meaning, again, like a real alternative for facilitated multinational trade, regardless of thinking crypto per se, but just bringing efficiency on those conversions, bringing efficiency in those transfers, those wires, and in the meantime, bringing back treasury efficiency back to the guys who are holding the assets.
This is a very interesting point. I just want to add on a little bit to that point on treasury efficiency that you mentioned, right? Which is something I'm seeing as well in the ecosystem, right? If you see a lot of treasuries out there, it can be corporate treasuries, it can be asset managers, it can be Bitcoin miners that are managing their wealth of Bitcoin, right? A lot of them are looking a lot into the staking ecosystem, right? as a first step, but then what next? Right, so on Ethereum, you're generating around 3 to 4%. On Solana, you're doing 8%. But then how else can you kind of make that strategy more efficient, right? So looping strategies, like what Arthur said, structured products, right? Derivatives on top of staking, right, is I think something very interesting as well to all these asset managers. So for example, dTRINITY's dTRINITY's staking vaults 1-inch Opium integration. I think these potential, interesting elements for a lot of these asset managers, treasury managers out there in this current market. Yeah.
Did you have a thought on that, David? I saw you raise the mic.
Yeah, I was just going to say, in terms of institutional adoption of crypto treasuries, right? You have the rise of digital asset treasury companies, right? It started with kind of MicroStrategy. And now, there's the Ethereum Bitmine, there's a new chairman, and now Ethereum Bitmine actually owns the greatest single holder of the greatest amount of Ethereum, right? We'll see more and more in the near term the rise of these type of companies, right? And the way that it's interesting is if you actually buy the stock of these companies, they're trading at a multiple of NAV, net asset value. And the reason why they're trading at a multiple net asset value is because of two components. The first component is, there's an expectation that they're going to actually buy more buy more Bitcoin or buy more Ethereum in the future, depending on what they're doing. That's one. And then two is they're also not just fully buying and holding the Ethereum. They're also allocating into certain fund managers that can generate Bitcoin on Bitcoin yields and generate Ethereum on Ethereum yields. So it amplifies kind of that return profile of the underlying asset, right? And a lot of people, even a lot of ventures funds, we're studying this, examining this, right, just to see where this will turn out. And I do think that more and more, as crypto becomes ingrained in everyday culture and all this stuff, right, you're going to see more and more of an allocation of traditional companies into crypto assets, whether it's in the traditional realm, which is basically, I want Bitcoin exposure, so I'm going to buy Bitcoin ETFs, or the native route, which is I want Bitcoin exposure, I'm going to go and buy Bitcoin on the native chain, right? Or I'm going to buy a wrap, asset of Bitcoin or something, right? To avoid the asset management fees. So that's kind of like my take on what's happening.
And the treasuries that you mentioned, if a bear market downturn happens and yields go down, how do these treasuries start?
Sure, that's a very, very good question. So you should basically study the capital structure of some of these digital asset treasury companies, right? And we actually studied this. So in the beginning phases of MicroStrategy, for example, they were highly levered. They were basically borrowing money and buying Bitcoin, right? Now, the issue with that is if there's debt covenants meaning, okay, well, if I'm a smart debt investor and I issue a debt instrument, right, I will basically say, well, if Bitcoin drops below a certain price, right, I'm going to get control of the equity of the company, right? What happens is the equity will get wiped out upon a decline of a certain percentage point. It's akin to getting liquidated, right, but on a corporate scale, right, on a very, very high level. That's how you think about it, right? But when you look into the capital structures of MicroStrategy now, it's actually not levered, right? And when you actually look at, for example, Bitmine, and you look at their acquisition strategy, they raised $250 million to acquire Ethereum, but that was a common equity raise. It was not a debt raise, right? So in cases like this, right, you're going to suffer less chances of liquidation. But the counter to that is, okay, I am investing in a vehicle that's basically Ethereum, but within that company, you're going to have incremental expenses because you got to pay people salaries and all of this stuff, right? But you're betting on the fact that these guys will know how to allocate into optimal yielding strategies that'll earn Ethereum on Ethereum yields, right, greater than the expenses that they have, right, to make sure that the multiple NAV makes sense, right? Otherwise, it's like, why are you paying a multiple net asset value, right? So that's an interesting point where we kind of like studied as well, right? Less chances of liquidation now, but before, definitely a chance of liquidation, especially if there's debt on the capital structure, right?
Yeah, for sure. We have only a couple of minutes left, so I think it's time to wrap it up with some final thoughts about what the next couple of years of on-chain yield looks like, which products will be the most popular, and how this will look in from an institutional perspective as well?
Well, on our side, very interestingly, we feel another wave of adoption is looking at a new way of wealth management. Essentially, what we've seen is the distribution of structured products in the 0 to 5 years as the way your financial advisors would be distributing it. The back end being what we've just described, so vaults of different risk profiles to the various stage. Managing on one side a cost of borrowing, then the yield that you can generate out of various, for example, even not just trading, lending, borrowing, then derivatives, right? You had OTC derivatives on top of that, and then build different strategies as structured products will be bringing probably the next wave of adoption for us from a grand public point of view, beyond crypto.
So I've been in the stablecoin space for 7 years. I don't think stablecoins are going to go away, right? I think we're going to continue to see increasing sources of stablecoin yield. So earlier, one of the questions was, what happens during a bear market when crypto native yields go down, right? I actually think this is where RWAs and bringing in traditional finance yield will help buffer that shock a little bit, right? So maybe now I rotate out of my SUSDE into like a, tokenized treasury, vehicle or something, right? So I think the stablecoin yield space will continue to mature. LSTs and, restaking is not going to go anywhere. I think the big category that's been growing that hasn't gotten a lot of attention is fee-based tokens, right? I mean, like Hyperliquid, but many DeFi protocols are starting to actually show like real revenue, like a business, right? This is what they promised in their white paper, like who knows how many years ago, but it's finally starting to play out, right? So you have, DAOs like Aave, like, Maker, which is now Sky, et cetera, right? Like they're starting to show real sustainable business models beyond just printing tokens out of thin air. And I think this trend will continue, and the bar for what makes like a high quality DeFi project is going to increase, every cycle. So I think that's going to be one of the new emerging trends. And then, of course, there's going to be some crazy thing that none of us can predict here that's going to take everyone by surprise, right? So, but in terms of the foundations, I think, stable coins as always, native yield is here to stay. And I think, real revenue generating project tokens are also going to start coming more and more.
David, any final thoughts?
I think David covered, this other David covered a lot of the, some of the points that I would raise as well, right? If I were to kind of project out like how yields will work in the crypto space or yielding protocols, right? I would also include, when people say like on-chain yields, I want to also include the bucket of if I have stable coins on a centralized exchange, right? And I want to easily get yield on that stable coin, I can easily just click a button and basically lend that out and get that yield. It's not on-chain, but I would argue that it's as easy as kind of like, on-chain yield. All of these verticals, right, of yield sources and all of this will exist, right? The difference is where users will go depending on the conditions of the market environment. And I think we both touched upon this, right? In a bull market environment, when people are willing to pay 10% to borrow USDT and USDC, you're going to see more and more people use crypto native yields. In a bear market, when no one wants to borrow and therefore there's no yield there, right? People are going to flee over to RWAs because they can earn they can earn the 5% on the treasuries, right? Who knows what kind of interesting other angles of yield there may be. I mean, Athena is one of them. It's a stable coin, but I consider it. It's not a fully collateralized stable coin. The yield is generally higher than what you can earn on the treasury side, but the yield is sustained through a structured finance product, right, on a very, very high level. Maybe we see more of those, right? Although the risk there is, we've all seen what has happened with pure algorithm stable coins like Luna Terra, right? Which is something that we don't believe in, right? You can't just create money out of thin air with no collateralization. So yeah, those are kind of like my thoughts thoughts, but highly unpredictable how this will all play out.
Yeah, I think that, the dominant kind of topic, and of course, a lot of the dominant share of assets are still in stable coins. But if I were just to pivot a little also to the crypto native side of things, right? So you see the POS networks or even the current POW networks, we'll continue. What I expect to see is that staking will still remain as the fundamental basic infrastructure of yield provision, right? For us, we call it rewards provision, right? And on top of that, right, what I expect to see is that more and more innovative elements are being built on top of just staking, because that's what our clients, institutions are looking for. So we have to really look out of the box, find a way to tie that back also to our USP, which is providing security, right? So at the end of the day, what we provide is not a financial product, right? It's more of a technological type product where the risks to manage are unique. And how can we incorporate that into the financial world, where it's more about collateralization, it's more about providing yield, generating yield from counterparties. How do we amalgamate that? And that's what I expect to see. And what I hope to see, right, is real world use cases that is not in the realm of financial products, right? So for example, right, some interesting, I would say maybe not so prominent things that I'm observing is that, not so prominent to the everyday person that I'm observing, is that on Eigen layer, interesting AVSs are being built, Eigen Cloud, and on it Eigen Compute, where essentially it's like an AWS or Google Cloud providing a security bond to it. So pumping in millions and billions of dollars, and if you have a mischief or you alter the data, these dollars actually get burned. So there's a huge disincentive to make a mistake or to lie, basically. So that's the value that I hope to see crystallize coming out of this entire staking, restaking ecosystem that will actually generate sustainable, real-world on-chain use. Yeah, thank you very much.
Well, thank you everyone. Thank you for listening. It's been super insightful and great conversation, and it sounds like we're right on the precipice of something that's going to be a major part of the ecosystem moving forward for a long time and moving into other areas. If you have any questions for anyone on the stage, grab them as they're walking out. Thank you, Figment. Thank you, Kronos. Thank you, dTRINITY. Thank you, Flowdesk. And I was from 1inch. So thank you all.